Welcome to Seniors Finance USA. I'm David Miller, and I'm here to help you take control of your financial future with clarity and confidence. You sold your old pickup truck after more than a decade of taking care of it, keeping it running, maintaining it the way responsible owners do. A neighbor made you a fair offer, $15,000 in cash, and you accepted. It was simple, straightforward, and completely legal. You earned that money honestly. You paid taxes when you bought the truck, and now you've sold your own property. There's nothing complicated about it, nothing questionable, just a normal transaction that happens every day across the country. You walk away with that envelope of cash, and like most people, your next step is obvious. You want to deposit it safely into your bank account. But then a small voice in your mind starts whispering something you've heard before. Maybe it came from a friend, a relative, or a passing comment years ago. Something about $10,000, something about the IRS, something about banks reporting large deposits, and suddenly, what should be a simple deposit doesn't feel so simple anymore. You start thinking, I don't want unnecessary attention. I'm not doing anything wrong, but I don't need the government looking into my account. Especially if you're retired, living on a fixed income, and you've spent a lifetime staying out of trouble, the last thing you want is to accidentally trigger some kind of issue. So you come up with what feels like a smart, cautious plan. Instead of depositing the full $15,000 at once, you decide to break it up. Maybe $8,000 today, then $7,000 next week, or perhaps 3 smaller deposits spread out over several days, each one safely under that $10,000 number you've heard about. It feels responsible, it feels careful, it feels like you're avoiding a problem before it starts. But what most people don't realize is that this exact behavior, the one that feels cautious, is the one that creates the biggest problem. This situation has played out thousands of times across the United States, and it continues to happen because most people only know half the rule. They know that banks report cash transactions over $10,000. What they don't know is that intentionally trying to stay under that amount can be interpreted as something far more serious. There's a specific federal concept behind this, and it's important to understand it clearly. Banks are required to report large cash transactions through something called a currency transaction report. This happens automatically whenever deposits or withdrawals exceed $10,000 in a single day. It's not optional, and it's not targeted at you personally. It's simply part of how the financial system operates. But alongside that requirement, there's another rule that many people never hear about. If someone deliberately structures their deposits to avoid triggering that report, even if the money is completely legal, that behavior itself can raise red flags. The key issue isn't the amount of money, it's the pattern. When deposits are broken into smaller pieces that consistently stay just below $10,000, especially within a short time frame, it can look like someone is trying to avoid reporting requirements. And in today's banking system, those patterns are not reviewed casually. They are monitored automatically. This is where things have changed significantly over the years. Banking is no longer driven primarily by human observation. It's driven by sophisticated software systems that analyze transaction patterns across millions of accounts. These systems don't know your story. They don't know that you sold a truck, or that you've been saving cash for years, or that you've never had any legal trouble. They only see numbers. They see timing, frequency, and amounts. And when those numbers match certain patterns, the system flags them. Multiple deposits just under $10,000 within a short period of time is one of the clearest patterns those systems are designed to detect. Once flagged, a report may be generated and sent to federal authorities. And here's something many people don't realize. You are not notified when that happens. There's no warning, no phone call, no immediate explanation requested from you. The process happens quietly, behind the scenes. This is why the misunderstanding can lead to serious stress later on. Not because the original money was illegal, but because the way it was handled raised concerns within the system. For many older Americans, this creates a particularly challenging situation. The instinct to keep financial matters private is not only natural, it's something that was considered wise for decades. Handling cash carefully, avoiding unnecessary attention, and maintaining personal control over finances were all signs of responsibility. But the system has changed. What used to be seen as caution can now be interpreted differently when viewed through automated monitoring. And it's not just about selling a vehicle. Think about all the legitimate reasons someone might have a large amount of cash. selling personal property, receiving insurance payouts, distributing assets from an estate, consolidating savings that were kept at home, or even receiving financial help from family members. All of these are normal legal situations. But when the deposits are split in a way that creates a recognizable pattern, that's when issues can arise. Another common misconception is that depositing more than $10,000 automatically triggers an investigation. That belief is widespread, and it's exactly what leads people to split their deposits in the first place. But the reality is very different. A large deposit by itself is routine. It's processed, recorded, and reported as required, but it doesn't automatically mean anyone is investigating you. Millions of these reports are filed every year. They exist primarily as records, not as triggers for immediate action. The difference lies in behavior that appears intentional. A single deposit of $15,000 is simple and straightforward. It tells a clear story. You had cash and you deposited it. There's nothing unusual about that. But 3 deposits of $5,000 over a short period can tell a different story to an automated system, not because of the money itself, but because of the pattern it creates. That's the part most people never get told. Some individuals assume they can work around this by using different banks, spreading deposits over longer periods, or involving family members. But these approaches don't solve the problem. In many cases, they can make the pattern more complex and more noticeable. Financial institutions operate within interconnected systems. Information doesn't stay isolated in one place. Patterns can be analyzed across accounts, institutions, and timeframes. So instead of reducing attention, these strategies can increase it. The reality is that there isn't a workaround that improves the situation. The safest approach is also the simplest one. Deposit the full amount. Let the bank handle whatever reporting is required. That's their responsibility, not yours. Your role is simply to deposit your money honestly and clearly. At the same time, it's a good habit to keep basic documentation for your own records. If the money came from a sale, keep a receipt or bill of sale. If it came from an insurance claim or inheritance, keep the relevant paperwork. Not because you're expected to prove anything in advance, but because having clear records is always helpful if questions ever arise. If you ever feel uncertain, you can also communicate openly with your bank. There's nothing complicated about it. You can simply say that you have a cash deposit and understand that standard procedures may apply. That kind of straightforward approach aligns with how the system is designed to work. It's also important to make sure that anyone who helps manage your finances understands this as well. Family members often try to help in ways that seem logical, but without realizing how certain patterns might be interpreted. A quick conversation can prevent unnecessary complications. Looking ahead, this topic is becoming more relevant, not less. Financial systems are becoming more automated, more data-driven, and more sensitive to patterns. At the same time, many people, especially retirees, continue to handle situations involving cash for completely legitimate reasons. That combination makes awareness more important than ever. There's no need to feel anxious about using your bank. There's no need to avoid cash deposits. The key is simply understanding how the system interprets different behaviors. When you act in a clear, straightforward way, your transactions look exactly like what they are: normal, legal financial activity. And that's ultimately the goal: to handle your money in a way that reflects its true origin without creating unnecessary complications along the way. If this information helped clarify something that wasn't obvious before, it's worth sharing with someone else who might benefit from it. These are the kinds of details that often don't get explained until after confusion has already started. And staying informed ahead of time makes all the difference. Seniors Finance USA is focused on breaking down exactly these kinds of topics in a way that's practical, clear, and easy to apply in real life. Because when systems become more complex, understanding them becomes one of the most valuable tools you have. The goal isn't just to avoid problems, it's to move forward with confidence, knowing that you're handling things the right way from the start. Stay informed, stay prepared, and keep things simple. Or guidance specific to your situation. And I'll see you in the next video.